Hello, and welcome to today's workshop on cash flow statements. Thank you for joining us. Whether you're new to financial reporting or just want a refresher, this session will help you understand how cash moves through a business and why that matters as a critical tool for the financial health of any organization.
Here's what we'll cover today: what cash flow is and why it's important, the structure of cash flow statement, operating, investing, and financing activities, real world examples, and how to use cash flow insights for better decision making. What is cash flow, you might be asking? Let's start with the basics. Cash flow is the movement of money in and out of a business. It's not the same as profit. It paints a picture as to how a company's operations are running, where money comes from, and how money is being spent. A company can be profitable, but still run out of cash, and that's a problem. Cash flow tells us whether a company can pay its bills, invest in growth, and survive tough times. There are many benefits, as listed here, including that it complements the balance sheet and income statement by rectifying the missing information on the P&L. It's a key indicator of financial health and often can be more telling than net income.
Now let's dive into what some trends there are and some key features to optimize business performance.
The cash flow statement is one of three core financial statements alongside the income statement and balance sheet. It shows how cash is generated and used across three categories: operating, investing, and financing. Analyzing patterns over time allows your business to anticipate needs based on past trends to plan accordingly. Monitoring your business's agility to take in more cash than it pays out gives you an indication of the business's ability to create the resources necessary for expansion or its ability to support the business. Next, let's review cash forecasting. In simple terms, cash forecasting is the process of predicting a business's future cash flow. It's based on a company's past performance and expected changes to its finances. It helps you anticipate whether you'll have enough cash to meet obligations, invest in growth, or weather unexpected challenges.
Here's a surprising statistic for you. According to a US bank study, a whopping 82% of small businesses fail because of poor cash flow management, not because they weren't profitable. That's why cash forecasting isn't just a financial task, it's a survival skill.
That's right. Let's take a look at how it works. There are solid steps that include choosing a time period to forecast. Usually, a quarterly budgeted forecast is useful. Estimated how much money will come in via inflows like sales, receivables, loans, and investments. Estimate how much money will go out via outflows like payroll, rent, inventory, loan repayments, etc. Compile that data into cash forecast and then compare the forecast to actual cash flow to see if your cash forecasting needs improvement. Timing wise, a weekly analysis can improve your forecast over time to see when cash moves, not when it's invoiced or booked. Accuracy depends on understanding both the amounts and the timing.
Exactly. Cash forecasting isn't just about predicting numbers. It's about giving your business the power to act, not react. With a good forecast, you can avoid cash crunches, plan for investments, and make decisions based on reality and not guesswork.
There are many benefits of cash forecasting to highlight. Think of it as your financial radar to show you where you are and where you're headed. What matters is consistency and gaining clarity. Businesses need to plan for future cash needs to sustain and grow operations. Knowing when there are periods of low cash flow is important to ensure there is enough cash to meet obligations. By having the data, a business can make informed decisions about how to allocate that cash properly. Next, we'll look at examples of when to use cash forecasting. There are two main approaches that can be used: direct forecasting, based on actual expected cash transactions, which is usually best for short-term planning, and indirect forecasting, based on projected income statements and balance sheets, that is useful for long-term strategy. A short-term cash forecast can cover the next 30 days and be used to identifying funding needs or excess cash. This will predict seasonal fluctuations in cash flow by using previous monthly trends, while the cash flow statement records actual cash flow and forecast predicts future cash flow. A budget predicts likely profit for the coming year, while a cash flow forecast predicts when that profit will translate to cash. At this time, we'll review limitations or common pitfalls of a cash flow statement. Watch out for these traps: analyzing further negative cash flow, overestimating sales, ignoring seasonal trends, forgetting one-time expenses, and not updating forecasts regularly. Forecasting isn't a one and done task. It's a living document. Having history of changes in cash flow from one period to the next gives any investor or stakeholder a better idea of how the company is performing.
Let's look at a real-world scenario. A retail business forecasts strong holiday sales, but forgets to account for increased inventory cost and delayed customer payments. The result? A cash shortfall in January. Forecasting helps you spot these issues before they happen.
Yes, cash flow from the example gives history to confirm its efficiency and reliable revenue streams are there while measuring the business's stability and provides net earnings, which come from the income statement. To build a reliable forecast involves sales, operations, and finance departments, as it's a team effort that is best done collaboratively. Another cash flow type to discuss is from investing, as it helps determine a company's growth potential and indicates potential liquidity sources. This category would include loans made to vendors or received from customers, any payments related to mergers and acquisitions, and any purchases or sales of assets. Also included would be changes in equipment or investments related to cash from investing. And lastly, another cash flow type is from financing. Cash from financing activities includes the sources of cash from investors and banks, as well as the cash is paid to shareholders. This includes any dividends, payments from stock repurchases, and repayment of debt principal that are made by the company. Cash flow from financing offers a clear picture of the business's debt management and dividend payments, helps banks access if you have enough earnings for future operations and growth.
Understanding the different types of statements is essential for assessing a company's financial health. The three types of cash flow statements, operating, investing, and financing, each offer unique insights into a company's financial activities and strategic direction.
To wrap up, cash flow is the lifeblood of any business. Understanding it helps you make smarter decisions, spot risks early, and supports long-term success. We want you to know that FLORES is here to help. As your trusted partner in accounting services, we want to remind you that our team is available to support you and answer any questions you might have regarding the material discussed today.
That concludes the workshop portion for today. If you need further assistance with understanding cash flow statements or forecasting, please reach out to our team and we would be happy to advise you. You may direct questions to our office at 619-588-2411. Thank you for attending and have a great day.